I'm Jennifer Schiefert. I am a senior manager here at SDK in the Forensic Accounting and Business Valuation Group. And here is our agenda for today. First, we're going to start out with just discussing some business valuation basics, such as why people need business valuations and different standards of values that are used in business valuations. Then I will go into detail on the three different types of valuation approaches there are. There's the income approach, the market approach, and the asset approach, and I'll give simplified examples of both. And then we'll end with our discussion of, based on our understanding of how the valuation approaches work, what are the drivers of business value? So what can you do to increase the value of your business, and how that impacts the actual purchase price that we see in transactions. And then we'll leave time for questions at the end, but feel free to ask questions as we go as well. So to start off, why do people get business valuations? And there's a number of different reasons. One of them would be if you're looking at buying or selling a business and you just want to have a benchmark as to what a reasonable price would be or comparable to the offers you are receiving or giving. We also do business valuations for gift and estate tax purposes if somebody is gifting an interest in their business, or if a decedent had an ownership interest in a business. And then we get into performing business valuations for litigation purposes as well. So that could be a shareholder dispute where one of the remedies is that one of the shareholders is bought out of the company. So it would be valuing the interest of that shareholder. And then for marital dissolutions as well, if one or both of the spouses own a business, you need to determine the value of that business to be put on the marital balance sheet that you're going to be dividing between the parties. So on this next slide, I have the three different standards of value. So the first standard of value is fair market value. And the definition of that is the price at which a property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, and both parties having reasonable knowledge of the facts. So this is a hypothetical value and not necessarily the value of a specific transaction. Then there's liquidation value. And so that would be the net amount you would receive if the business was terminated or if you sold the assets piecemeal. And finally is investment value. So that would be the value you would use when you're looking at buying or selling a specific business. So investment value is different from fair market value in that fair market value is a hypothetical buyer, and investment is a specific buyer. And so with that specific buyer, you're going to take into account the specific motivations of that buyer, their expectations, the required rate of return, and any synergies they may perceive will happen in the future. And one other business valuation basic I want to discuss that I didn't put on there is the valuation date. When you're looking at a business valuation report, if you receive one, it's very important to see what the date of the report is, because as part of the business valuation process, you perform a valuation as of a specific date. So you only take into account what is known or knowable as of that date. So in some instances, a valuation that was done the previous year may still be relevant, but in other instances, a lot could have changed, and so you wouldn't want to rely on that value. So the three approaches for valuation are the income approach, the market approach, and the asset approach. So the income approach is the approach that's most commonly used when you're valuing closely held companies. And the premise of that approach is that the amount that a buyer would pay for a business is the amount they expect to receive in the future from that business. So in order to calculate value using the income approach, The two variables or factors you need to determine are your estimated future cash flows or earnings from the business and a discount rate that reflects the expected risk of not receiving those earnings. So to start with your future cash flows of the business, what we usually look at as a guideline is to look at historical earnings and then make some adjustments to those so that they're more representative of what you would expect to receive in the future. So these adjustments can include ownership control characteristics. For example, if the owner of the business also works for the business and is receiving compensation from that business, one of the adjustments you would make would be to that compensation to make sure it is equal to market compensation, because the buyer of the business wants to know the cash flows, assuming that they would hire an unrelated outside party to perform those duties that the previous owner was performing. You're also going to make any adjustments for if there's discretionary or personal expenses that don't necessarily relate to the operations that you can take out. You're going to make adjustments for any non-reoccurring and unusual items. So this can include if there's forgiveness of a PPP loan, you want to take that out because that's not going to occur in the future, or if you had extra expenses maybe related to COVID, such as purchasing plexiglass dividers or anything like that. Since those are more of a one-time deal and you don't expect those to reoccur in the future, you're going to adjust those out. You're also going to remove any non-operating assets or liabilities. If you have marketable securities or excess cash in your business that aren't used for the business or necessary, you're going to take those out and any income or expenses that are related to those. And then when you're done valuing the operations of the business, you will add back the value of any non-operating assets and liabilities to get an idea of the total value of the business. And finally, if you are looking at doing a valuation using the investment standard of value, this is where you would adjust for any synergies you expect in the future. So for example, if you think you will be consolidating office facilities, you would decrease your estimated rent expense in the future. So the next item would be to come up with your discount rate. And that is the rate that the market would require as a rate of return to invest in this. And so to come up with a discount rate, we typically use a build-up method. So as part of that build-up method, you start with what your risk-free rate of return is. And then you're going to add to it the additional risk associated with the business. So first, we typically add an equity risk premium, which is equal to the return an investor would expect if they had a diversified portfolio of stock. And then some industries are considered more risky than others, so you would add additional risk for the industry. And then finally, you add additional risk specific to the company. And that can be in the form of looking at the management of the company. If you're reliant on maybe the owner, he has all the business relationships, that would be more risky to a buyer to see if you could transfer those relationships or not. You'd also look at the financial statistics and financial ratios of that company compared to the industry, see how their leverage or profitability to compare to see if there's more risk or less risk with this specific company. And then also you would look to see if there's any dependence of the company on specific suppliers or key customers, as that would also affect the risk.
Jennifer, there's a question in chat.
I don't see the questions. I'm sorry.
Okay, that's okay, I do. How is
Okay.
valuation impacted when there are duplicate owners collecting income from the business?
I'm sorry, can you repeat it one more time?
How is valuation impacted when there are duplicate owners collecting income from the business?
So I guess so you can look at the value in a number of different ways. You can value the business as a whole, and that is, let's assume if you're using fair market value and you're under your hypothetical approach, you would adjust the compensation of all the owners so that it would equal the market value of those owners. If you are valuing the ownership interest of a specific individual, and it impacts whether or not that individual, their ownership interest, if they have a controlling interest and they can change that compensation or not. Lots of times, if there's a minority interest and they don't have a lot of control what the other owners may take out as compensation, there will be a discount. You'd value the business as a whole, and then you value their pro rata portion, and then you take a discount for lack of control, if that makes sense. So moving on to this slide, this is just a visual representation of a simplified example of the income approach. And here it can be viewed as a mathematical fraction. So in this example, expected annual net cash flow, discount rate, and expected long-term growth are expected to remain constant. So we don't have to do a forecast into the year. We can just use 1 year to come up with our value. So as an example, say a business expected to have 100,000 of annual cash flow. And we calculated the discount rate of the business to be 18% and our long-term growth to be 2%. So our formula would just be 100,000 divided by 16% equals 625,000 for the value of the business. So you may hear the term capitalization rate sometimes too, and that's really just the bottom of this fraction. Capitalization rate is equal to your discount rate minus your long-term growth. And if you're more used to viewing business values as some kind of multiple of earnings, the capitalization rate is just kind of the inverse of the multiple. So if you do 1 divided by 16%, you would get 6.25. So your multiple of earnings when coming up with the value would be 6.25 in this example. So now moving on to the market approach. So the market approach is based on the principle of substitution. So how much does a similar company, what is the value of that? And so you compare it to the sales of other comparable companies or the price to earnings multiple of comparable publicly traded companies. So it sounds pretty straightforward. Of course, the tricky part of this is finding a company that's actually comparable to the one you're evaluating. So in looking at comparability, we typically look to make sure it's in the same industry. We also look at the size in terms of both revenue and or assets. And a general rule that we follow is you want to exclude anything that has revenue or assets that are 10 times greater or 10 times less than your company. And we'll also look at the financial ratios of the public or the comparable company to your companies to see if they have similar gross profit percentages or similar net income percentages for comparability, as well as looking at historical trends and expectations for growth. So to come up with guideline data, first we look to see if there were any prior transactions of the company stock. And if there was, to make sure that these were arm's length transactions, because that can set a precedent for the value of the company. Then also we look to see if there's any publicly held companies that are similar enough, because there's a lot of data available. Usually though, when we're evaluating closely held companies, the publicly traded companies are too large to be considered truly comparable, or they're more diversified, so have multiple different business lines where our company might just be similar to one of those lines. We also at SDK subscribe to a number of different databases that include a lot of information on transactions of privately held companies. So we can view those databases and find transactions of sales of privately held companies and look to see what the selling price was, what the revenue was, what the income and gross margins were related to those privately held sales, and see if we can find comparable data that way. So here is another simplified example of evaluation. And so in this example, using the market approach, we have selected a multiple of 0.4 for our price to revenue. And again, that would be based on looking at privately held transactions and finding ones that are comparable enough to our company. So we start with that multiple, and then we multiply it by our company's revenue to get our value indication. And then we make a number of adjustments, because when we're basing it on the guideline transactions, it's important to note what assets and liabilities were transferred in those transactions, and then add back any additional assets that our company has that were not included in those transactions, such as in this example, we add back cash and real estate. And then if you are using as your guideline transactions asset sales of companies as opposed to stock sales, then you're also going to want to subtract any liabilities that your company has to come up with the value of your business. So, and finally, we have our asset approach. And that is the most simple approach. And that's the concept of that is that the value of the company is best determined by valuing the cost of replacing or replicating the underlying assets. And this is the approach that's commonly used for valuing holding companies. And so two different methods under this approach would be your net tangible asset value. So for that approach, you're going to start with your balance sheet, but it is not the same as your book value. Instead, you're going to adjust all your assets and liabilities to their fair market value, assuming that the business is a going concern. And then you're going to remove any intangible assets, such as goodwill and blue sky. So what you have left is just your net tangible asset value. And then the difference between your market approach and your income approach, the difference in that value would represent the difference of those intangible assets. And then there's also liquidation value under the asset approach. And again, that's valuing the assets and liabilities at their liquidation values. And you can have either a forced or an orderly liquidation, with a forced liquidation resulting in lower values of your assets. There's also a number of rule of thumbs that you can run across for specific industries. And these were developed over time as a result of actual transactions. But if there have been changes in the market or the industry, they might not be very appropriate. And they're usually in some form of a multiple of a financial measure, such as 1.5 times operating cash flow or 2 times revenue. However, sometimes there's big ranges within the rule of thumb, like 1 to 3 times EBITDA. And to where you fall in that range is very important. But they shouldn't be used solely as a way to valuing a business. Sometimes we use them to check the reasonableness of the values we got under other methods. We do have access at SDK to a resource called the Business Reference Guide, where you can look up rules of thumb for different industries or franchises, and they'll give you the rules of thumbs and the ranges, and also different pricing tips from brokers. So it is helpful to look at to see what the market is looking for and how they are valuing a company, but not as a specific valuation method. So now, based on understanding the various factors that we look at when valuing a business, you can kind of see how what information will increase or decrease the value of that business. So the next couple of slides, I have list various drivers of business value, ones that increase and on the opposite side would decrease the value. And when we're looking at drivers of business value, usually if we think back to the income approach, they're either going to be items that affect the risk of the business, either increase the risk or decrease the risk, or items that would affect your expectations for future cash flow. So I have these broken out into different categories. So this first category is drivers of business value related to the specific product. So items that would increase the value would be proprietary products, a strong brand, patent or trademark products, or diversified products. Also, products early in the product life cycle tend to increase value because there's more room for future sales and growth with those products. On the flip side, products that have a lower value are Me Too products that are just like competitors, products near the end of the product life cycle, or if one product makes up a large percentage of your sales. So that again would affect the risk of the business. These next group of drivers of business value relate specifically to the operations of the business. But again, they're either going to affect your risk or your expected future cash flow. So items that would increase value or decrease risk would be a diversified customer base, a strong management team, and that would have decreased value because the new buyer can rely on that management team to keep the company operating, as opposed to, we had discussed earlier, if the seller is a key person in the business. Other things that would increase value is the ability to grow with the current equipment. You have excess capacity, so there is room for growth. And then how the financial ratios of your company compare with the industry. On the flip side, if you're dependent on one or a few customers or key suppliers, that would increase the amount of risk, or if there's major investment needed soon in the plant and equipment, that would affect your future cash flows. Or if your financial ratios are below the industry average, again, that would affect the value as well. So then our last list of drivers of business value relate to the external environment. So ones that you necessarily don't have control over, but affect the value nonetheless. So first of all is competitors. If you have weak competitors, that would have an increase of value versus strong competitors would decrease the value. For your market share, if you have a large or healthy market share or increasing market share, those can also have a positive effect on value. And on the flip side, if you have a weak or declining market share, those would have a negative effect on value. And then other external factors would be if there is legal or government action that can have an effect on value as well. Or if you're in an industry where there's evolving or heavy regulations, that tends to decrease the expected value. So with that, I think I will flip it over to Ryan.
Thanks, Jennifer. Like Jennifer, I am a senior manager in SDK's Forensic Accounting and Valuation Services Group. So Jennifer provided a great background, and now I'm going to bring those topics to real life. And much of what I talk about is going to be under the lens of a transaction, so a purchase, sale, but certainly it can apply to other scenarios as well. So let's just jump right into it. 6 things that you can do to build value now. First and foremost, since we're all accountants on our end, audited financial statements. So this is going to bring credibility to the numbers. And in addition, the discipline associated with this step will ensure strong internal financial controls that are essential to good management. So later I'll provide a little bit more detail on cleaning up the financials, but if you haven't had audited financials in the past and you're considering a business transition, what a great time to do this, to get the financial statements in order. I equate this to if you're going to be selling a car or selling your home, oftentimes they are worth the most or look at the best, at least when you buy them and when you sell them. So we should at least do that with our business as well. Build out your management team. A strong team that can run the business greatly broadens the universe of potential buyers. And the other thing is we often talk about maximizing value. And each of these individual steps doesn't necessarily mean that dollar for dollar, you're going to get more for the business when you sell it. It's really about options. It's really about the number of buyers coming to the table that process itself can raise the value of your business. Financial projections and business plans are of primary interest to buyers and reflect well on a company's management and provides comfort for the buyer. And Jennifer touched on this, but this is really what we're trying to accomplish, is bringing comfort to the buyer, de-risking the business, which goes into the next one of diversification. So concentrations of any kind are bad. Customers, suppliers, products, service offerings. Eliminate any key dependencies in operations, including those indispensable employees. Increase margins and cash flow. Well, easier said than done, right? But focus on opportunities to improve pricing, ways to cut costs, efficiently manage fixed asset investment, proprietary content of any kind can improve margins and reduce risk. And then grow. Always be on the lookout for new opportunities. New products and new markets are good. Make sure current offerings are getting proper sales and marketing effort. Remember, value is driven by future cash flow, not what happened yesterday. So the next slide. So at this point of the presentation, after everything that Jennifer's talked about and my 6 things, perhaps you share the same opinion as this gentleman. If it would be easier, don't think about it as maximizing value, but rather defining what success looks like if you are considering transitioning your business. To achieve this success, as defined, you need to create transferable value. Transferable value is basically the expectation of the same or better financial results with the new owner. I often hear about sweat equity. I've put so much time into my business. I really need to be compensated for that. Well, sweat equity is irrelevant. Otherwise, the following slide would hold true. So furthermore, no buyer will ever be kind enough to simply pay the amount necessary for a business owner's lifestyle upon their retirement. Buyers are seeking ROI, as Jennifer alluded to earlier, investment value. So a question for you business owners out there, and for you advisors, you could ask this as well. Would you invest in your company today from scratch? Ignore the sweat equity. At the end of the day, it's really about managing expectations. You want to avoid the scenario in the following slide. So a portion of my practice is working in post-acquisition disputes. I find it fascinating. But when working with sellers in these matters, it's not uncommon for them to feel disappointed in the process and the outcome, and that they really didn't have the appropriate advisors in place. Unfortunately, the transition for the business owner should be a positive experience. Otherwise, you wouldn't be going into this in the first place. So how can we make it a positive experience? Well, the next slide will show some ways to clean up the financials. First and foremost, record all income. Make sure the financial statements agree with the tax returns. This happens all the time where we get financial statements and they don't match the tax returns. Remove the personal expenditures. And then much of what I'm going to discuss from here on out has to deal with generally accepted accounting principles. So do you have an adequate allowance for bad debts on the books? Have you record prepaid expenses? You should record any transactions with the related parties at market value. For example, it's very common to have a related party own a building and then charge rent that's below market value. All of this should be adjusted to represent market value. Remove obsolete or damaged inventory from the books, or at least record an allowance for such. And that goes along with accurately recording value of your inventory. Same thing with your fixed assets. If you have anything that's obsolete, damaged, get it off the books. Make sure you've recorded all liabilities. This definitely goes along the same lines of where is the risk in the business. You do not want unrecorded liabilities, unknowns to the buyer. You have lease obligations, accrued property taxes, wages, vacation, other benefits. Accrued vacation is a big one. So in a lot of what I do in the post-acquisition dispute arena is the most hotly contested issue is GAAP versus consistency. Buyers often represent that their financial information is on GAAP. But in reality, it's just consistently applied. So the purchase agreements historically have said the financial information has been presented in accordance with GAAP. Then over time, it's transitioned to say the financial information has presented in accordance with GAAP, consistently applied. Well, what does consistently applied mean? Does that mean at the end of the year, at the end of the quarter, every day? So now the purchase agreements that I have seen now say the financial information has been prepared in accordance with generally accepted accounting principles, consistently applied throughout all relevant periods. So we really want to make sure you're understanding what you do. Just recording things at the end of the year may not be appropriate. So the next slide will provide a little bit of a real-world example of the value range multiples. So this slide is actually prepared by our friends at Sunbelt Business Advisors. We've teamed with them on a few other presentations, and they've been kind enough to share with us this information from their toolkit. So they have different scenarios as well. Jennifer touched on customers and suppliers and the external environment. And we have information about how that directly affects the multiples as well. There's other spectrums for industries and end users, but for the purposes of what we're talking about today, I want to talk about just the management and the financials, and primarily the financials. So these multiples are on EBITDA. So you can look at this, you business owners, and say, well, where do I fall in each of these columns? Little to no accounting systems. So this could be you're literally preparing your financial information on spreadsheets. Perhaps you're using QuickBooks, but really not to its fullest extent. Line items are very broad. not much specificity. Or perhaps as you move across the spectrum, you're getting into QuickBooks, you're using it for inventory management, for payroll, everything's integrated, and you have a good understanding of all the capabilities of QuickBooks. And then as you move forward off to the right, when you get into more ERP and other sophisticated information systems. Again, you may have confidence in the numbers, but you want to provide comfort to the buyer. So no CPA involvement indicates potential risk. You can move to the right on the spectrum if you get compiled or reviewed financials. At least there's someone else looking at this. And then audited financial statements. Many people, non-accountants or the uninitiated, believe that audited financial information means you've verified everything. Obviously, that's not the case. You're providing reasonable assurance that there's no material misstatement, but that goes a long way in a business transaction. Jennifer touched on the management. Is one person involved in everything? Or do you have a well-rounded management team consisted of many members? Because again, the buyer is really looking for a turnkey operation here. How about accounting? Is everything outsourced? Or do you have a controller on staff who's really got their finger on the pulse? Or do you have a very well-rounded accounting team as well? When performing due diligence engagements, I will go through these types of items, and items on the left give me pause, take a deep breath, make a note. These are the types of information I need to pass on to the potential buyer. So when I come back to them and say, oh boy, they have unsophisticated accounting systems. They've never been audited or reviewed. There's one person who knows everything. What do you want to do? That's going to result in a lower multiple for your business. Similarly, if they have personal expenditures that they've been running through the business for years and they've never taken them out or adjusted for them in advance, I have to bring that information along, and it just leads to the question of, what else is in the financial information that I need to be aware of? Similar to if you've ever bought a home, you start seeing this doesn't look right, that doesn't look right, that doesn't look right. You start asking yourself, what else could be wrong? What else has been neglected? So again, there's many other different scenarios and spectrums that I can provide. I didn't provide them for purposes of this presentation, just out of the interest in time. But if anybody has any questions on how this type of information may relate to their specific business, happy to pass that along. Just reach out to me or Jennifer and we can get back to you. That's it for my presentation. I wanted to save enough time for questions. So with that, I would open it up.
Okay, thank you, Ryan and Jennifer. Does anybody have questions? You can either unmute yourself or add it to the chat. Or if you have something to add, I know there's a number of folks on here who have lots of experience and knowledge. So Patrick says, what if you are in a high growth industry?
Well, clearly high growth industries will result in higher values. We're seeing a lot in the tech industry. If you look at the NASDAQ, they get very high multiples. And when we're dealing with interest rates that are in a rising environment, it's the NASDAQ. So depending on what's going on with interest rates these days, the NASDAQ and the S&P and Dow are going in opposite directions. But clearly high growth industry is a much better scenario than a stagnant industry, the old blue chips. I don't know if Jennifer has more to comment on that.
No, I mean, other than saying, yeah, that's definitely one thing that affects the value as when we're building our discount rate that's used to determine value, we look at some resources that have it by industry, like what is the appropriate industry risk premium that you should add. So we would look up that industry and that would include information. It would, for high growth industries, you can actually have like a negative premium. So it would reduce your discount rate, so increase your value.
Okay, Patrick, if you had another question, feel free to ask a follow-up on that. And Bob is wondering if you can comment on the proposed Biden tax changes. And I know there are SDK tax people in here, if that it's beyond you guys.
Yeah, I'll probably steer clear of that.
Anybody else care to comment? I know Nancy's in here, Stan's in here. But no Steve or Lori, and they're the ones that give our normal. You have to unmute if you're thinking about speaking. All right, let's go on. Bob, maybe if you want to ask more detail on what you mean by the tax changes. And then Larry's wondering how has COVID affected valuations, for example, hospitality industry. Ooh, that's a good one.
So it's definitely affected valuations because you need to project what's expected in the future. So when you're looking at a company, I mean, we had talked about you're going to make all your normalization adjustments if you had increased expenses or you got PPP loan forgiveness. But with those, as opposed to the simplified version I showed you with only a 1 year, because you're expecting things to remain constant, you're really going to have to come up with like a 3 to 5 year projection that you think is reasonable and what you expect to achieve in order to value the business.
Yeah, and I was working on a divorce matter that involved a business and how the value of the business was going to be a key component to the marital estate. And Jennifer had mentioned earlier that when you're taking into account the value of a business, you do it as a specific date, and only things that are known or knowable as of that date are relevant. So the value of the business, the valuation date for that business was in 2019, and nobody knew what COVID-19 was at the time. Trying to come up with a presentation of future cash flows for 2020, 2021, and 2022. We're looking at it for 3 years, and then to discount it back. And there was a real argument over what those cash flows were going to be, and then future arguments over whether the valuation date should be changed. And so big thing, valuation dates before COVID was a known event are different than valuation dates after 2019.